So we're on chapter 5 this week. We're moving right along. And this week we're going to talk about some unique items that retail businesses have, unlike service entities. When you think of a retail business, we're thinking of Target, Walmart, Home Depot, Dollar Tree. You guys, can you think of any that are your favorites? Sporting goods store. Shields is like one of my favorite. I guess that's not really a sporting goods store, but Shields is like awesome. Love that store. Those are all retail companies. And with the retail company, they sell products, goods. And so with selling those goods, they have purchased merchandise. So retail businesses sell merchandise that they've purchased from other companies. Companies selling the merchandise to the retailers are the vendors or suppliers. The transactions between the suppliers and the retailers are called business-to-business transactions. Sometimes we call it B2B, business-to-business. Transactions between retailers and consumers, which are what you and I are sometimes called business-to-consumer, B2C transactions. So if someone is a manufacturing company, they're going to sell those goods to a retailing company, B2B, business to business. The retailing company that sells their goods to the end user, which is you and I, can be called business to consumer, B2C. Now, the operating cycle of a business, if you think about it, companies need cash. Now, cash is king. They always say that, but it's true. If you don't have cash, you're going to have a hard time staying in business. They need the cash in order to purchase the merchandise. The merchandise arrives in the store, and the goal is to buy enough merchandise to sell to keep the inventory as low as possible. But you need enough inventory so you can sell the goods. Once those goods are sold, oftentimes the money doesn't come in right away. So there's an accounts receivable that happens. And then the money needs to get collected so the cycle can just continue to repeat itself over and over again. So here, the operating cycle here is the process by which a company spends cash, generates revenues, and receives cash from customers. The operating cycle of a service and retail business differs in that a retail business needs to purchase the merchandise in order to sell it to the customers. This shows a financial statement or an income statement of a service business and a retail business. You see, with a service business, there's not a cost of goods sold. They're selling a service. Whereas in a retail business, their sales consist of you purchasing products. So in the retail business, you see sales, you see cost of goods sold, gross profit, then operating expenses and operating income. Within a service industry, you see you've got fees earned, but you're not going to have any cost of goods sold because there's not a merchandise to be sold. It's more of a service that's being sold. The revenue activities of a service business are providing some type of service to customers. But with a retail business, it's all about buying and selling merchandise. Now, I also need to be careful on that. I was in PetSmart picking up dog food yesterday, and there are retail businesses that do provide services also. Does that make sense? So, you can get your dog groomed there. That is a service. But primarily a retail business is you're selling products to the consumer. When merchandise is sold, the revenue is shown as a sale, and its cost of goods are an expense. So we'll talk about that in a minute here. Okay. The product, when it is sold, will be removed from inventory and shown as a cost of goods sold or cost of merchandise sold. The cost of goods sold is subtracted from sales to arrive at a gross profit. The amount gross profit is what we call it because it's the profit before deducting all the operating expenses. So if you look back here, you see we show sales minus the cost of goods sold is gross profit, okay? Merchandise on hand that isn't sold at the end of the period, we call inventory. Inventory is a current asset, okay? It's going to be on the books as a current asset. We can't write off inventory until it's sold. Inventory is shown on the balance sheet as a current asset. So let's look at this first exercise. During the current year, merchandise is sold for $23,680,000. The cost of goods sold is $13,024,000. So we sold those goods for $23,680,000, but we paid for them $13,024,000. The amount of gross profit is going to be the difference between the two, right? So you take the $23,680,000 minus the $13,024,000, that's your gross profit. The gross profit percent is just what that gross profit is divided by your sales. So do you see the gross profit is 45%? Because they have to mark up the products. That's how they make their revenue, right? When there is a gross profit, will the income statement always report operating income? Not always, because you've got all these operating expenses. So operating income, if you have income, it's because your gross profit minus your expenses give you an operating income. You could have an operating loss too. Got it? How about this one? For a recent year, Best Buy reported sales of $51,761 million. Its gross profit was $11,640 million. What was the amount of Best Buy's cost of goods sold? Can anyone figure that out? $40 million. Exactly. It's the difference, right? $40,121,000 was the cost of goods sold. Is that making sense to you? Okay. Monet Paints is a newly organized retail business with a list of accounts arranged in alphabetical order. Construct a chart of accounts, assigning account numbers and arranging the accounts in balance sheet and income statement order. Each account number is 3 digits. The first digit indicates the classification. 1 is for assets. The second digit would be current assets. The third digit is to identify what type of account it is. So basically, here's a list of all the potential accounts for this business. And what they are trying to have you do is see how accounts get ordered. Assets are all accounts that begin with a 1. Liabilities are accounts that begin with a 2. Owner's equity are accounts that begin with a 3. Income revenue accounts begin with a 4. Expenses a 5. You see how now every company does it a little different, but basically the concept is assets all follow a certain number, liabilities follow a certain number, and so on. No, as you see here, the current assets all have a 1-1. Okay, 1-1. The long-term assets, property, plant, and equipment, do you see how they have a 2 after it, a 1-2? Liabilities, these are all current liabilities, so they have a 1 after the 2. What is the purpose of this? Just so you understand how you assign numbers to the various accounts. Now, how do we go about showing when we record merchandise and when we sell merchandise? Merchandise transactions differ from those of a service business. The accounts related to merchandising transactions are going to be shown here. With all companies, service industries or retail industries, you're going to still have cash. You're going to have accounts receivable, office supplies, everything in black. You're still going to have those. But the difference with a merchandising company, you're going to have inventory. You're going to have inventory returns, or however they want to label that. You're going to have customer refunds, estimated coupons payable. What you're seeing are new accounts that are going to be specific to a merchandising company. Got it? This company, Net Solutions, is a retail business. And so we also see on their income statement, they're going to show sales. They're not going to show fees earned. They're showing sales. They've got a cost of goods sold. And depending on, their specific type of retail industry, they're going to have a delivery expense also. Okay? A subsidiary ledger is basically a bunch of individual accounts that have a common characteristic. So subsidiary ledgers can be like accounts receivable. Accounts receivable might have a ton of different customers. They're all accounts receivable, but each customer will have its own sub-account under accounts receivable. We call that a subsidiary ledger. The primary ledger, where we post everything to, is called the general ledger. Each subsidiary ledger is shown in the general ledger by what we call a controlling account. So think about even accounts payable. There might be 100 different vendors or suppliers we have to pay money to. So they're all accounts payable, but we will have within the accounts payable a lot of different individuals that we have their own account, a subsidiary ledger is what we call it, where we keep track of what we owe each individual. Same with accounts receivable. Common subsidiary ledgers are just what I was saying, the accounts receivable and the accounts payable. An inventory subsidiary ledger lists all the inventory by barcode. Have any of you guys worked at a retail company? You guys have. So this sounds familiar to you, doesn't it? As far as, thank God for computers. How did they do it before computers? Keep track of the inventory on hand. The controlling account is in the general ledger, and the inventory subsidiary ledger shows all the line items. Most retail companies use computerized accounting systems that record similar transactions in separate journals: purchases, sales, inventory reports. So there's two ways in which companies keep track of merchandise. The perpetual method is it's always current, always on hand. You know exactly, or you're supposed to know exactly how many items of X is on the shelves. A periodic inventory system is one where periodically, every so often, they run a count in the store and update their records. Not as smart, but some companies still do it. I remember, and even though businesses may have a perpetual system, it's not always accurate. You know, when we were building our home, I wanted these certain baskets in all our closets. And so I went to each Menards to get everything they had there. And some stores would say they had 24 on hand, and yet I'm only seeing 13. So they're not always perfect. And those of you who've worked, do you get what I'm saying? Why? Theft? I don't know. But yes?
It's probably because when they counted inventory, they had more customers than that.
It could be. Okay. Instead, a listing of inventory on hand, we call that a physical inventory count. So even though if it's a perpetual system, you still do an inventory count just to see where you're off. So when items get purchased under the perpetual system, we will always debit our inventory and we would credit either cash or accounts payable. So when we purchase inventory under the perpetual method, we debit our inventory and we credit cash. Okay? Both are assets. When we purchase inventory on account, we're going to debit our inventory and credit our accounts payable. So one's an asset and the other is a what? Liability. Okay, now the terms of purchases on account are indicated on the invoice or the bill. The terms for when payments for merchandise are to be made, we call them credit terms. If payment is required at delivery, then we would call those terms cash or net cash. Otherwise, the buyer is allowed a certain amount of time, known as the credit period, in which to pay. So here's an example of an invoice. It shows who it was sold to, shows the date, when it was shipped. Do you see it says terms of 210 net 30? You guys see that right here? The 210 net 30? Basically, what the Alpha Technologies is saying is this bill of $3,000 is due in 30 days. However, if they pay this bill within 10 days, they get a 2% discount. Okay? So they can get $60 off of their bill if they pay this bill within 10 days. Got it? Payments may be due within a stated number of days after the invoice date. The terms are net 15 or net 30. If payment is due by the end of the month in which the sale was made, the terms are written net EOM, end of month. Okay? So, how does this work? For Alpha Technologies, if the invoice date is January 5th, and it says 210 net 30, you are given a 2% discount if you pay the bill before January 15th. Otherwise, you pay the full amount within 30 days. Okay? Business-to-business purchases oftentimes include a discount by the supplier to encourage the buyer to pay before the end of the credit period. For example, a supplier may offer a 2% discount if the buyer pays within 10 days of the invoice date. If the buyer doesn't take the discount, the total amount of the invoice is due within 30 days. Okay? Discounts taken by the buyer for early payment are called purchase discounts. Purchase discounts taken by a buyer reduce the cost of the merchandise purchased. So if we say the invoice was at $3,000, but if they take that discount, they're only going to pay $2,940 because they get $60 off. So in essence, they're paying $60 less for that inventory. Okay?
Why wouldn't they take a discount?
They don't have money. I mean, in a perfect world, it's just a smart thing to do. Okay? If an annual interest rate is sitting at 6% over a 360-day period, the interest on the loan for the remaining 20 days of the credit period is basically $9.80. So it's always about making money happen. Cash is king, guys, because without money, you can't do much. The net savings to Net Solutions of taking this discount is basically $50.20 if they look at an interest rate of 6%. Because, you know, money, wherever it's sitting, it can earn interest. So you have to take into account what is that interest really accruing. So by them paying it ahead of time in this scenario, it's saving the company $50.20. The savings can be seen by comparing interest rates on the money saved and by taking the discount and the interest rates on the money borrowed to take the discount. Under the perpetual inventory system, the buyer, when the goods are sold, debits inventory and credits the payable. When the bill is paid, and if they take the discount, they're going to ultimately reduce the amount of inventory. So instead of showing the inventory was $3,000, when they pay the bill, do you see the accounts payable will be for the whole $3,000? They show they're paying $2,940, and that difference they're crediting to inventory because they actually didn't pay $3,000 on the inventory. They paid $60 less. Does that make sense? So under the perpetual system, you always credit the inventory when you take a discount. If Net Solutions didn't take the discount, they're just going to show a debit to accounts payable for $3,000, a credit to cash. Does that make sense, guys? Yes?
How would that 60 to inventory being credited? Would that not mess with, like, I guess it's only on the accounting side, but would that not mess with their inventory numbers?
No, because it's on the accounting side. Basically, if you think about it, your inventory numbers are one thing, but this just reduces the cost per inventory item. Okay? Okay, purchase returns and allowances. A buyer may request an allowance for merchandise that is returned or a price allowance for damaged or defective goods. From a buyer's perspective, returns and allowances are called purchase returns and allowances. In both cases, the buyer normally sends the seller a debit memo to notify the seller of reasons for why the item was returned. So if you think about it, when we take discounts as a buyer, we just credit our inventory because we're paying less for those goods. But as a buyer, if we're returning items, we want to keep track of what we're returning and why, and see if there could be some type of history or situation as to certain suppliers were returning more. Does that make sense? So we want to keep track of purchase returns and allowances. We're not just going to necessarily credit our inventory. We want to know what was returned. A debit memorandum, often called a debit memo, informs the seller of the amount the buyer proposes to debit to the accounts payable for the seller. It also states the reasons for the return or the request for the price allowance. The buyer may use the debit memo as the basis for recording the return or allowance or wait for approval from the seller. Remember, every economic event that we take needs to have some type of backup paperwork. So that's what they're trying to say to you. Here's the backup paperwork in order to prove why we are reporting a purchase return. Either way, we're going to debit accounts payable and we'll ultimately credit the inventory. This is just showing the debit memo. To illustrate, Net Solutions records the return of the inventory indicated in the memo. Before paying an invoice, a buyer may return inventory or be granted a price allowance for an invoice with the purchase discount. Let's see here, on May 2nd, we purchased $5,000 of inventory on account from Delta Data Link, terms 210 net 30. Then on May 4th, we returned inventory with an invoice amount. On May 12th, we paid for the purchase of May 2nd, less the returns and discount. How do we record this? The first, on May 2nd, when we purchased the goods, we debit our inventory, we credit our accounts payable. When we returned some goods, we debited our accounts payable and we credited inventory. And then when we paid the bill, we debited the full amount for our accounts payable. Since we took advantage of the discount, we credit our inventory by that $80 and we credit our cash for the difference. When you're doing cash sales, it's a lot more straightforward. For the seller side, this isn't the buyer, the seller, when they sell goods for cash, the seller will debit the cash, credit the sales. But think about it. There's two sides to the equation. One is showing the cash and what we sold it for. The next portion is taking that out of our inventory and showing the product to be a cost of goods sold. Using the perpetual inventory system, the cost of goods sold and the decrease in inventory are also recorded at the same time at the sale. The inventory account indicates the amount of inventory on hand at the end of the period. So in this case, when we sold $1,200 worth of product, we show that as an expense, debit our cost of goods sold, but we have to take it out of our inventory because we don't have that inventory anymore, okay? Sales may be made to customers using debit cards, such as bank cards. When a customer uses a debit card, the money required by the purchase is deducted instantly from the customer's bank account. We do record debit card sales as cash sales because they get that money fairly quickly. Sales may also be made to customers using credit cards. Credit card sales are normally processed by a clearinghouse that contacts the bank that issued the card. The issuing bank then electronically transfers cash directly to the retailer's bank account. Okay? I don't know about you, but I don't like using debit cards because I know a lot of people like the debit cards, but if you have an issue, it's a lot harder to get your money back than if you use a credit card. It's just interesting. Okay. If a retailer allows customers to use debit cards to pay for purchases, oftentimes they're charged a processing fee. Fees are periodically recorded as an expense, like a bank fee, or in this case, we debit credit card expense and credit the cash. When businesses sell merchandise on account, that means they're going to set up an accounts receivable, right? The seller records sales as a debit to accounts receivable and a credit to sales. Here, assume Net Solutions sold merchandise on account to Digital Technologies for $18,000, terms net 30. So there's no discount being offered here. The cost of the merchandise sold is $10,800. The way this would be shown is a debit to accounts receivable for $18,000 and a credit to sales for $18,000, and also another journal entry that takes those goods out of inventory and debits cost of goods sold. So you see, we debited cost of goods sold and we credit inventory. Does that make sense, guys? Net Solutions would record the receipt. So when Digital Technologies pays them on April 9th, when they got the check in the mail, they debit the cash and credit the accounts receivable. Because now the accounts receivable has been satisfied, right? Retailers can offer various incentives to help increase sales. There can be sales incentives, promotions, and discounts. Sales incentive and promotions are often distributed by retailers through newspaper, magazine, internet. So coupons and rebates are basically incentives. The coupon just discounts the product right away at the purchase. Rebates provide the customer a refund after the product is purchased. How many of you guys ever take advantage of those rebates? Good for you. They're harder to do.
Menards makes them up absolute pain to get that 11% back on everything.
They do?
That's Menards' entire scheme is that they 11% rebate on everything,
And
but they make it a nightmare
to do it.
to get it.
Interesting. I don't know if I've ever done, and we shop at Menards a lot because it's right there. The accounting for coupons or rebates depend upon the terms. A coupon has no value and the retailer ultimately has no obligation until the customer purchases the product. Ultimately, with a coupon or when they're choosing to discount an item, basically, think of it like this. How often do you see that an item is worth $100, but this week it's 25% off? Well, and you're just paying 25% less for the item. So the sale is going to be $75 instead of $100. The sale is $75. So the accounting is just really straightforward in that respect. Yes.
Sometimes businesses would be like, "Oh, this is a sale," and they have like a marked down sticker. But if you've ever looked under the sticker, it's either been like a cent difference or it's.
Oh, I know. It's such a, I hate to say the word scam, but.
Yeah. Then it's like, oh, it's like that, and then it's underneath it. It's exactly the same.
I know. You know, I started making these silly, how do I explain it? So it looks like the shape of Minnesota, and I'm going on Etsy and eBay to buy all these little pins, like a Boundary Water pin or a canoe or like a Vikings player, you know. So my daughter, who's now in Nevada, I made one of these in a frame and I buy these pins. What's been frustrating for me with eBay and Etsy, they might sell them for $5 or $6, but the shipping is $5 to sell a pin. You know, it's just, you're going to pay one way or another. When Wellborn Stores offers a coupon on its website for $3 off the customer's next purchase of $15 or more. So basically what's happening is these point of sale coupons, if the company or if the individual comes back in, she's going to get $3 off. Assume that Becky Lewis purchases $45 of merchandise, submits the $3 coupon, and pays cash. The $3 coupon just reduces the revenue from the sale. Assuming the merchandise cost Wellborn $27, then you would see the cash is $42. The sale will be shown as $42. And then at the same time, you have to get rid of that inventory on your books. You credit the cost of goods sold, debit the cost of goods sold, and credit your inventory. Assume that a coupon is issued when the customer purchases merchandise. In this case, when the retailer sold the merchandise, it incurred a future liability to the customer. As a result, the retailer must estimate the dollar value of coupons that will be redeemed, ultimately reduce sales, and record a liability. So in this case, to stimulate summer sales, Grand prints a coupon on the bottom of its May 2026 sales receipt for $3 off the customer's next purchase of over $20. They can be redeemed between June 1st and August 31st. If Grand merchandise sold $40 million of product, sold the merchandise for $40 million and generated $6 million sales receipts, the cost of the merchandise sold would only then be $21,500,000. Grand estimates 20% of the coupons will be redeemed before they expire on August 31st. Kohl's does that a lot. You know, if you purchase something, they'll give you X amount off if you then purchase it within the next month. If Grand Stores accepts only cash, Visa, or MasterCard, it would record the sale as a debit in cash. They would credit the sale for $36,400,000 and show estimated coupons payable, which is a liability for future, of $3,600,000. And again, alongside of that, get rid of the inventory and debit the cost of goods sold. Grand Stores has incurred a current liability. In this case, we call it estimated coupons payable to its May customers. Since it's estimated that only 20% of its May customers will redeem the coupon, so in that case, they're only estimated $3,600,000 as the liability. Okay, let's not get bogged down in this. Sorry about that. Sales, incentives, promotions, and discounts. The accounting for rebates is going to be similar to that for coupons. Instant rebates, which are redeemed at the time of purchase, just reduce the sales. But the mail-in rebates require the retailer to estimate the dollar value of the rebates that will be redeemed, reduce the sales, and record the liability. A buyer can return merchandise that's defective or damaged for whatever reason. If the buyer has already paid for the merchandise, the seller may pay the buyer a cash refund. If the buyer has an outstanding accounts receivable with the seller, then the buyer may request an offset against the accounts receivable. Sometimes sometimes it's helpful just to do some exercises because we get bogged down in this. Let me just look here. Okay, let's talk about freight real quick, and then we'll work on some problems. Purchases and sales of merchandise always require freight, for the most part. The owner of the merchandise may pass to the buyer when the seller delivers the merchandise to the freight carrier. When it said free on board or FOB shipping point, that basically means the buyer's going to pay for the freight. So if Net Solutions purchases merchandise from Magna Data, $1,200, and the terms are free on board shipping point, and the paid freight of $50 on June 10th, paid freight of $50 on June 10th, purchased from Magna Data. So whenever it says free on board shipping point, the buyer's paying. If it says free on board destination, the seller's paying. Net Solutions would record these two transactions. When they purchase the inventory, they're going to debit inventory, they're going to credit the accounts payable. When they pay for the freight, they're going to debit inventory. So if you think about it, the freight costs are part of the inventory price. So you're going to debit that inventory to keep track of what actually it cost in the product. Think of it like, even though you might have a deal on purchasing goods, if you're spending $1,000 in shipping, it's got to be added to the cost of the product. Okay, so that's why you debit the inventory. If merchandise is sold, $700 on account, terms FOB destination, then in cases like that, the shipping is free to the buyer, the seller is paying the shipping. Okay, let's see. Let's sales taxes. How about this? On May 15th of the current year, Newport Beach, a retail store, receives an invoice from one of its vendors, Suntime Umbrellas, for $2,800. The payment terms are $115 net $30. Newport Beach Goods pays the invoice on May 29th. How much will it pay? See? Perfect. 1% discount is what would that be? $28. Higher math here. Okay, does that make sense, guys? Let's look at some problems, and then if we need to fine-tune it, we can go back to some of these slides. I don't want to get so caught down in the details, I lose the steam here. The stationery company purchased merchandise on account from a supplier for $14,500, terms $210 net $30. The stationery company returned merchandise with an invoice amount of $3,500 and received a full credit. What is the amount of cash required for the payment? And then under the perpetual inventory system, what account is being credited by the stationery company to return the item? So if we show they originally bought it for $14,500 and returned $3,500 worth of goods, wouldn't that net be $11,000? right? 11,000. If they take a 2% discount on that 11,000, that would be $220. So the 11,000 minus the $220, do you see the amount of cash they need is $10,780? Make sense? And when the company returns those goods, they're going to credit the inventory. And I said that incorrectly earlier. The seller will keep track of anything that got returned because they want to know, not necessarily the buyer, the seller. How about this one? A retailer is considering the purchase of 1,000 units of a specific item from either two suppliers. Their offers are as follows. Supplier 1, $34.80 a unit with a discount of $110 net 30 and no charge for freight. Or supplier 2, $35 a unit, $210 net 30 plus freight of $200. Which of the two offers yields the lower price? Perfect. One does. So do you see 1,000 units? Supplier 1 would be at $34,800. Supplier 2 is at $35,000. The discount, supplier 2's discount is much higher, but when you have to take into account supplier 2, you having to pay freight, ultimately it's going to be cheaper to go with supplier 1. So it's important to look at all the terms. Okay? The debits and credits from 4 related transactions, 1 through 4, are presented in the following T accounts. Assume that the freight terms were free on board shipping point and that the credit terms were $110 net 30. Describe each transaction. So what we're trying to do is help you become familiar with what happened, what transaction took place in order to have a certain debit or a certain credit. So for number 1, if you look, inventory is debited for $14,000 and then accounts payable is credited for $14,000. So in that case, purchased inventory on account. Pretty straightforward. Okay? Number 2 is a debit to inventory for $150, a credit to cash for $150. That was paying for freight. Number 3 shows a debit to accounts payable for $2,000, a credit to inventory for $2,000. In that case, it's pretty obvious they returned some merchandise. And then 4 is a debit to accounts payable, a credit to cash, and a credit to inventory. So it's pretty clear they paid their bill and took the discount. Okay? Make sense? Stylon Company, a women's clothing store, purchased $48,000 of merchandise from a supplier on account, terms free on board destination, $210 net 30. Stylon returned merchandise with an invoice amount of $7,500, receiving a credit memo. Journalize Stylon's entry to record the purchase, the merchandise return, the payment within the discount period, and then the payment beyond the discount period. So the first thing we do is we debit inventory, we credit accounts payable for the purchase, right? Straightforward. When we return inventory, we debit accounts payable, credit inventory for that which we're returning. When we pay for it within the discount period, we'll debit our payable, we'll credit cash and credit inventory. The credit for inventory is the discount that reduced what we owe. And then if we paid the bill outside of the discount period, we just debit our payable and credit our cash for the whole amount. How's everyone doing? What about this one? Journalize entries for the following related transactions of Lilly Heating and Air Company. Purchased $36,000 of merchandise from Shell Company, terms 110 net 30. What are we going to do? Debit inventory, credit the payable. Paid the amount of the invoice within the discount period. 1% of $36,000 would be a reduction of $360. So the entire accounts payable gets debited. The cash is going to be 99% of the full bill, and then we credit our inventory for the difference. Now what happens when we discover that merchandise with an invoice amount of $9,000 purchased was defective and we return the items? We have to show that portion of the discount we took because we didn't pay $9,000 for it all. We only paid 99% of $9,000. Does that make sense, guys? Then, when we purchase $5,000 of merchandise on account, debit inventory, credit the account. When we received a refund from Shell for return in the C above less the purchase, we'll debit our cash and credit our payable. Okay? Journalize these transactions. We sold merchandise for cash, $25,000. The cost of the goods sold was $17,500. Remember, we'll always have two transactions here. We will debit our cash, credit our sales, but then we also have to get rid of that inventory. We debit cost of goods sold and credit our inventory for $17,500. When we sell merchandise on account for $98,000 with the cost of it being $58,800, we debit accounts receivable, credit our sales, and then we also have to remove the inventory by debiting cost of goods sold, crediting inventory. Okay? Sold merchandise to customers who used MasterCard and Visa, $475,000. The cost of goods sold was $280,000. Remember, we'll debit our cash, credit our sales, and then debit our cost of goods sold and credit our inventory. Sold merchandise who used American Express. The cost of goods sold was $39,000. Again, we'll debit our cash, credit our sales, and likewise, we have to get rid of our cost or get rid of our inventory by debiting our cost of goods sold. We received an invoice from National Clearinghouse Credit Company for $13,450, representing a service fee paid for processing MasterCard, Visa, and American Express. We'll debit our credit card expense or bank fees, however you want to call it, and we credit our cash. Is this making sense to you guys? Yes? Now let's look at sales promotions. At the bottom of all its February sales receipts, Seifert Stores printed off $20 coupons. The coupons may be redeemed March 1st through April 30th. Seifert Stores accepts only cash, MasterCard, or Visa. During February, Seifert Stores completed the following transactions. Sold merchandise to Marcy Andrews with a list price of $175 that cost Seifert $80. Marcy presented a $5 off coupon, which she clipped out of the local newspaper. Marcy used her Visa card for the purchase. And then on February 18th, sold merchandise to Chris with a list price of $50 that cost Seifert $24. The bottom of Chris Johnson's cash receipt includes the $2 off coupon. So what are we going to do here? Assume Seifert sold $25 million of merchandise in February, which generated $12,500,000 printed sales receipts. The merchandise sold cost is $16,500,000. Seifert Stores estimates that the 15% off the $2 off coupons printed in February will be redeemed before they expire April 30th. So 15% of the $2 off coupons will only be acknowledged. So what are we going to do here? The cash, this February 6th transaction, it was a list price of $175, but Marcy gave that $5 off coupon. Do you see we're going to just debit our cash and credit our sales? And likewise, also do the same with the cost of goods sold. Debit cost of goods sold for $80, credit our inventory. Then, what was sold to Chris Johnson, debit the cash for $50, credit the sales. And since the cost of goods is shown at $24, we debit our cost of goods sold, $24, credit our inventory. Then we have to show a reduction, those coupons payable 15% of 12,500,000 printed sales receipts, the $2 off, is going to be $3,750,000. We'll debit our sales for that amount and credit estimated coupons payable for the future. Okay? So know this is how you'll handle those coupons that will be redeemed in a future period. Using the data from exercise 511 just before, assume that Seifert Stores sold $40 million of merchandise in March and that $1,400,000 of the $2 coupons were redeemed. The cost of the merchandise sold is $23,600,000. Journalize on March 31st the March sales for Seifert Stores. Assume Seifert sold $33,500,000 of merchandise in April and that $440,000 of the $22 off coupons, not 20, I'm sorry, were redeemed. The cost of the merchandise sold was $19,100,000. And then what is our balance sitting in that estimated coupon payable? So for the first one, the debit of cash, here, let me just go back to what this is. It's $40,000. So we're going to debit the cash of $37,200. We'll debit our estimated coupons payable of what was redeemed here of $2,800,000 and then credit our sales. Now, again, remember, we always have to do that other transaction where we show cost of goods sold and credit our inventory. Then for the next month, we debit our cash of $32,620,000, debit that estimated coupon of $880,000, credit our sales, and likewise our cost of goods sold. So if you look at what the balance was, and then what was debited in both months, there's a balance sitting in the coupon payable of $70,000. Okay? because that estimated coupon payable had to have been used up by the end of the second month, we can then get rid of what wasn't used. So by that way, we debit our coupon payable and credit our sales. Delta operates Sky Miles to give its members an incentive to fly Delta. Passengers earn mileage by flying on Delta, which can be redeemed for airline flights, rental cars, hotels in the future. How should Delta Airlines record the sale of a $500 round-trip ticket that earns 1,500 Sky Miles? Assume an average value of 0.012 cents per Sky Mile. So basically, $18 of that ticket is going to go into a liability account. Because remember, we have a liability when we have a future obligation to someone, right? Goodyear published the following promotion on its website for the purchase of the Wrangler AT tires. $25 back with purchase of 4 tires by rebate via the MasterCard prepaid card. Assume Jeannie Blanchard purchased 4 Wrangler Trail Runner tires for her Jeep at $120 per tire. That's cheap, isn't it? With free installation plus 5% sales tax. When Goodyear posts the rebate on its website, should it record an estimated liability? No, because nothing's attached to, until sales occur, they don't even know who's going to take advantage of that liability. With Jeannie using her Visa, 4 tires at $120 is $480. The sales tax of 5% on $480 is $24 for a total cost of $504. How much would Goodyear record as sales from the sale to Jeannie? They're going to subtract that $25 rebate. So they're only going to show the difference. Got it? Are y'all getting bored? Sorry, I don't know of another way to do it but to go through exercises. Sorry, guys. On September 28th, Silverman Enterprises sold $18,500 of merchandise to Beasley with terms net 30. The cost of the goods sold was $11,200. On December 31st, Silverman prepared its adjusting entries, yearly financial statements, and closing entries. On January 3rd, Silverman Enterprises issued Beasley a credit memo for returned merchandise. The invoice amount of the returned merchandise was $4,000, which originally cost them $2,350. Again, how do we record it? Initially, we debit our receivable because they didn't pay us with cash. We credit our sales. Then we debit our cost of goods sold for the cost of the merchandise, $11,200, credit our inventory. Then they return merchandise. So when they return merchandise, we debit our customer refunds payable and credit our accounts receivable because we want to know of items that were returned. We increase our inventory and credit our estimated returns inventory. When they finally paid, we receive our cash and credit our accounts receivable. We did a problem like this earlier. So the same thing holds true. Here we're looking at the, what was debited, what was credited, and hopefully you then can be able to understand what transaction took place. So I'm not going to go through these just because we've done it before. Here, similar, when we sell merchandise on account, we know we debit our receivable, we credit the sales. You always have to show how much was the inventory cost. Anyway, you guys can look at these, okay? This is a good one, though. Determine the amount to be paid in full settlement of each of the following invoices, assuming that credit for returns and allowances was received prior to payment and that all invoices were paid within the discount period. So I want, how about a group of you guys work on A, a group B, a group C, a group D, and E? How about, who wants to do A? Can someone do it? Who wants to do B? Don't make me call on someone. I promised you I never would, did I? Try. Give yourself a couple minutes and try, and then we'll go over it. Just take one of them and see if it's making sense to you, is the bottom line I want you to do, okay? Okay, A, does anyone want to say what would happen here? Yes.
30,400.
30,400. Perfect. B, who wants to take B? Yes.
12,972.
The purchase was
Oh, I did a 10%, not a 20%. A 1%, not a 2%.
okay, yeah, you see it's 2%.
Yeah.
So do you see that? The purchase minus the return plus the freight. 10,394. C? Who wants to take C? Anyone? C is going to be the 21,000 minus the return and 1% discount.
Did you do the 1% discount before or after the return on an allowance?
I thought it said that the returns all happened prior to being paid. So ultimately it all should work out the same, but I thought it said the allowances were received prior to payment and that all invoices were paid within the discount. So this is taking the 1%. Ultimately, the net amount's going to be the same, right? If we take the 21 minus the 4, that's going to be 17,000. With the 1% discount, that would be 16,830, right?
Yep.
D, we've got the merchandise of 9, the return of 1,000, the 2% discount, and freight of 175. So the 9 minus the 1,000, that's 8, and the 2% discount plus the 175 of freight gives you 8,015. And then lastly, the 77.4 at 1% is 76,626. Yes.
Go to C again or B again? 'Cause I got the other one.
12,8 minus the 2,500. 12,8 minus 2,500. Take the 2% discount, and then add the $300 freight. Did I do it wrong?
Oh,
Okay, how's everyone doing? I'm not gonna, you guys can go back and look at some of these. But again, we've gone through a lot of these. Know that when the seller, not the buyer, but when the seller has goods returned to them, then the buyer wants to keep track of the customer refunds payable. They're issuing they're showing how much was reduced based on what was returned, and they credit the estimated returns inventory. Okay? So be aware of that when you're dealing with the seller. Let's look at this one. Well, this is a purchase. Showcase, a furniture wholesaler, sells merchandise to Balboa. On account, $254,500, terms net 30. The cost of the goods is $152,700. Showcase issues a credit memo for $3,000 for merchandise returned prior to Balboa paying the original invoice. The cost of the merchandise returned is $17,500. Journalize Balboa's entry for the purchase, the return, and the payment of the invoice. So initially, the purchase, we would debit the inventory, we'd credit the payable. When they returned inventory, not for $3,000, for $30,000, sorry guys, you would debit the $30,000, credit the inventory, and then when the bill was paid, it'd just be the difference, the $254,500 minus the $30,000. Okay? Let's talk about sales tax because I kind of skipped over that section. Journalize the entries to record these transactions. We know that sales tax, you will collect the sales tax, but it's a liability because the seller does not keep that. It goes straight to the state. When a company sold $640,000 of merchandise on account, subject to a 7% sales tax, the cost of goods sold is $385,000. Know that the accounts receivable is going to include not just the product, but the sales tax. But know that the sales is only for the $640,000. The sales tax payable even though it's coming in, it's going to go right out to the state. Okay, so we owe that money. That's a future obligation. We debit the cost of the product that we sold, the $385. Here, when we paid the sales tax to the sales tax agency, the state, we're going to debit the sales tax payable in credit cash. Okay? Because that sales tax is going to just accrue as a payable until we pay it. Sometimes we need to adjust our inventory. Sometimes things walk away. Sometimes for different situations, if we're dealing with maybe a Nintendo a game and a newer one comes out, the older ones lose their value. Do you know what I'm talking about? Or be it golf, whatever you have, the new ones come out and then the old ones become not worthless, but reduced. So let's talk about under perpetual system, when we're dealing with inventory shrinkage, the inventory account always gets updated when we have purchases and purchase returns. Retailers normally experience some loss of inventory. So when you take a look at the physical inventory on hand, we call that, from what shows on our books to what really is there, we can call it an inventory shortage or shrinkage. In order to adjust for the inventory shrinkage, what's really not there, we're going to just debit our cost of goods sold and credit our inventory. Because it's no longer there, we just have to show it as an expense. After the preceding entry is recorded, the balance of inventory now agrees with what's really in the store, the physical inventory. Since inventory shrinkage cannot be totally eliminated, it's considered a cost of operations, okay? A buyer who has already paid for merchandise may decide to keep the merchandise and accept a partial return from the seller. So this is dealing with when buyers return goods. To illustrate, assume in a prior example, Blake & Sons agreed to keep the merchandise in return for a partial refund of $900 from Net Solutions. In this case, Net Solutions would record a debit to customer refunds payable and a credit to cash. So oftentimes, or not oftentimes, but say I ordered a bag that was supposed to be black and it got delivered to me blue. Now, I don't want to return it per se, but it's not what I ordered. So oftentimes they might give me a discount. Does that make sense? When that's the case, here's how it would work. A debit to customer refunds payable and a credit to cash. Sellers are required to estimate customer returns, refunds, and allowances at the end of the accounting period. Based on these estimates, 2 adjusting journal entries need to happen. One is to record debits for sales and credits for customer refunds payable. And the second entry is to show estimated returns inventory and credit the cost of goods sold. So in this case here, you see our sales of $715,000, our cost of goods sold. We show our estimated returns inventory. We show our customer refunds payable. And then we estimated the cost of merchandise returned for sales that took place in 2028, $5,000. Estimated percent of refunds of 2028 sales, 1%. So what we're going to do here is the 2 entries will debit our sales to reduce it, credit our customer refunds payable that we assume will be future returns. And then we take and debit our estimated returns inventory and credit those cost of goods sold. After all is said and done, we then have an adjusted trial balance. And from that adjusted trial balance is where we would do our financial statements. Guys, at the end of the reporting period, an adjusting entry is recorded to write off the reduction of inventory due to shrinkage. If the amount of inventory shortage is considered normal, the adjusting entry is a debit to cost of goods sold. Okay, it's a normal part of operations. What do we do here when we have some inventory shrinkage? Omega's tires in the perpetual inventory indicate 3,145,000 of merchandise should be on hand, but the physical count only shows 3,113,500. Aren't we going to debit our cost of goods sold and credit our inventory for the difference? It's gone somehow. We need to adjust for it, and it would be an expense. Okay? Good, guys? Stats had sales of 1,800,000 and related cost of goods sold of 1,150,000 for its first year of operations. Stats provides customers a refund for any returned or damaged merchandise. At the year end, Stats estimates that customers will request refunds for 1.5% of sales and estimates that merchandise costing $16,000 is going to be returned. Assume that on February 3rd, BCK company returned merchandise with an invoice amount of $5,000 for a cash refund. The returned merchandise originally cost Stats $3,100. Show the entries. So we need to estimate at the end of the year, we need to estimate what they figure refund requests are going to be. So we're going to debit our sales. We're going to credit customer refunds payable. And then we're going to show the estimated returns inventory. This is all estimated with the cost of goods sold. Then when one really happens, when a refund in that next year really happens, since we had that credit out there, we're going to debit our customer refunds payable, credit the cash, and do the opposite, debit our inventory, credit our estimated returns inventory. Okay, so we estimate it at the end of the year, and then for the next year, when it happens, we just go in and plug into those accounts that we originally set up. So ultimately, guys, we're at the end here, I hope. How do I have 250 slides? My goodness. Basically, we're at the end. We're now going to create financial statements. Retail businesses have a little different type of financial statement. You can do what we call a single-step financial statement or a multiple-step financial statement. The reason we call it a multiple step is because it contains several sections and subsections and subtotals. So as you see here, we've got our sales, cost of goods sold, and then our gross profit. Then we've got our operating expenses that give us our operating income. Then we've got other revenues and expenses to end up with our net income. So we've got several layers of profit: our gross profit, our operating income, and then our net income. Sales to customers for cash or on account are reported in the sales section. Cost of goods sold are next, which then give us our gross profit. Our operating income includes all of those administrative expenses and selling expenses. Then, after our operating income, we've got other revenues and other expenses that aren't normal in the normal course of business. So other revenue could possibly be the sale of a building or sale of land. Other expenses would be items that really aren't normal in the normal course of their business. After those is where we then have our net income. The single step income statement is much easier. The income statement deducts total of all expenses in one step from the total of all revenues. So you see how we have our sales and rent revenue all together, and then all of our expenses together. The negative with the single step form is that gross profit and operating income aren't recognized. So you don't really know what your gross profit was from selling the goods. The statement of owner's equity here assumes that Chris Clark made an additional investment of $5,000 in Net Solutions. The net income of $80,400 gets added to the owner's equity account, and the withdrawals are shown here too. This is the same thing that we went through last chapter. That's the same. The balance sheet is different in that you've got a couple different layers or accounts for inventory. In this case, you see inventory, and then we have our estimated returns inventory that we keep separate for future returns. We also have store equipment, the accumulated depreciation, all of that's going to stay the same. But in our liabilities, we have a new one for retail business, the customer refunds payable. That's estimating what in future years may be returned that we have to keep a liability on. There could be estimated coupons also payable here. So those are some new items we haven't seen before. When we close the books, it's just like we've done everything else. We're going to zero out the revenue accounts and zero out the expense accounts and zero out the dividends or the drawing account. Okay? So that's not changed. Just like in the previous chapter, we close out the revenues by debiting them, we close out the expenses by crediting them, and we close out the drawing account by crediting that and flow it all into the capital account. Okay? There are some differences between the single step income statement and the multiple step income statement. Which of the following items would not be shown on the single step income statement?
Gross profit.
Awesome. This basically explains that with an income statement, we break down selling expenses, we break down administrative expenses, or possibly other expenses. So just know that depending on if it's being used for selling the products, it's going to fall under the selling title. Admin are mainly those related to the home office, the main running of the business. Let's see here. Here, what they're trying to help you understand is that sales minus cost of goods sold will always equal gross profit. So if you're missing one of them, one of the items, you can figure it out if you have the other two pieces. Got it? Yes? No? Okay. Here, guys, I'm so sorry. I didn't realize when I created this slide how much, but I think I have so many exercises. That's what's made it so long. Here, to create a multiple step income statement, what they want you to notice is where the different items go. Now, an income statement only has Sales are revenues and expenses. So items such as office supplies or payables or any liability or inventory assets don't go in the multiple step income statement. We would have revenues and we would have expenses. So no, for the income statement, we've got our sales, our cost of goods sold, our gross profit. We've got our expenses, the selling expenses, the administrative expenses, and possibly any other revenues and expenses, okay, to end up with our net income. So just be aware, look at the account and go, okay, what kind of account is this? They're giving it to me, but it doesn't belong in the income statement. Okay, so here is how the following income statement was prepared. Identify errors. Well, guys, you know, sales minus cost of goods sold equal gross profit. Then from there, your expenses will give you operating income. And then ultimately, you'll have your net income. Just know the order, okay? The single step income statement is so easy. You group your revenues, you group your expenses. It's very straightforward. There's negatives to it because you don't get to see the various layers of income. To close the books is going to be just like the previous chapter. You close only temporary accounts, which are revenue accounts, expense accounts, and the drawing account. So you're going to close your sales, you're going to close your expenses, and it flows into the capital account. Okay? I'm not going to worry about this asset turnover, but please look at it. It's other ratios that help people make decisions about companies. Okay? Now know that you want your assets used effectively. So the higher your ratio, the better it looks for the company, okay? Sales discounts, I think we kind of went into the various sales discounts. No, there is another method of recording sales discounts that I'll let you look at here. There's too much here. Purchase returns, we talked about all that. Periodic method, and I do want to bring this up. I'm sorry, guys. Ooh. No, there are two methods you can use to record income, or the inventory. You can use the perpetual method, which is the most common. The periodic method is lacking in a lot of reasons, primarily because they don't keep track of what's really going on in the books or the inventory. No, with the periodic method, you're going to have some different accounts. Instead of putting everything in inventory, you're going to use purchases. You're going to use purchase returns, purchase discounts, and freight in. Know that the wording is different in a periodic inventory than is used in the perpetual. So take a look at this. If you guys have any questions, take a look at this. And again, I am so sorry I'm not going through all this, but you've got some journal entries here and some examples of this. Now, you guys have a good day.